Well, everybody, thank you for being here. This is an exciting opportunity. Jay, it only took two or 300, deals to underwrite to get to this one over the last few months.
Hundreds for sure. In 8 months, I think our last one was closed on December 31st, 2024.
Yep.
So 8 long months, but I think we finally have a winner. So
Yeah, really excited about this opportunity. Yes, thank you for all being here. Solid property. As we mentioned earlier, if you guys are just hopping on this call, all three of us on the screen walked through every single one of these 72 units yesterday. So we saw every unit, the insides. We did our inspections yesterday, and we were very happy with the results. So, Jay, without further ado, let's get right into it and show people this opportunity that we're excited about. So I did a little summary here of this forward-looking statement because it's very long-winded, a lot of legalese. So basically, this presentation includes forward-looking statements and based on management's beliefs and current information. So these statements involve risks, right? Investment always involves a risk, and uncertainties that may cause actual results to differ materially. They cover company prospects, distributions, returns, and projections. No obligation exists to update them, and reliance beyond this presentation state is discouraged. So basically, do your own due diligence. We're going to provide you with this information, but it is an investment. So we're going to do our best to show you what we think of it, and we'd love for you to join us as a partner. So let's get right into the story, Jay.
all right.
So this is a great B-plus class property on the east side of Cincinnati, only about 15 minutes from where I personally live. We had the opportunity to get this property under contract from another great operator here in town who is in his investment cycle. He had the opportunity to sell or refinance, and he's looking to sell, so we got the opportunity to get this under contract. Really great property. We walked every unit. Yesterday, 62 or so of these 72, Jay, were renovated, correct?
That is correct. Yep.
Yeah. Really nice finishes, granite countertops, stainless, LVP throughout, updated HVAC. I think every single water heater I saw in the building was brand new. So, which we photographed and took pictures of. So what does this opportunity provide you as an investor? We are looking for $100,000 minimum investments, and this is a 506C investment. So this would be for accredited investors only. For those that aren't familiar with what an accredited investor is, we will have some time for Q&A at the end. And also, we have already got quite a bit of verbal commitments and some inbound commitments already coming on this property before we could even get the webinar off today. So it's exciting to see all of the interest in this. What we find is an opportunity here is a potential to really add cosmetic value throughout, further renovating the 10 units, common area upgrades. The list we'll go over with you for our CapEx updates as well throughout this presentation. But Jay and I and DJ have really looked at where can we find more risk-adjusted return opportunities. And Jay, do you want to talk a little bit about that and how our philosophy and our strategies somewhat changed from our heavy value add strategy over the last 2 or 3 years?
Yeah, absolutely. And actually, we did a webinar on this topic, which we are more than happy to share with you all. But essentially, in multifamily, the multifamily world has definitely evolved, right? I think there was tremendous opportunity in heavy value add deals, meaning you buy a distressed asset and then you completely renovate the asset inside and out. And then that would also mean that you would basically reposition the entire asset in terms of the tenant base as well by turning around the culture at the property. So you're churning all the tenants and basically having some of the problematic people who have delinquency issues and stuff like that go and bring in newer, better quality tenants. And this whole process takes a significant amount of time and it's expensive. So it's only worth doing if the returns on that investment of capital and time is worth it. And what we are seeing is lately those returns have not been worth it. We have always targeted about 25 to 30% ROI on renovations or heavy lift deals. And right now we are seeing around 17 to 20% ROI on renovations. So the juice is not worth the squeeze anymore. And that's mainly because of a few factors like declining rent growth. Everything's more expensive. Cost of materials has gone up and the impact of tariffs is still a TBD. So it looks like materials pricing is going to stay elevated. But all of these factors play a role. And if the juice is not worth the squeeze, then why buy something that has a lot of renovation requirement and take on that construction risk? Because there's a lot of risk that comes with construction. Instead, we shifted our focus to buy something that was relatively turnkey, has some value add potential at the same time, but that cash flows day one. That way, if we have to buy an asset and hold on to it for a long time, we are cash flowing. And the other key aspect is that we are only looking at assets in A and B areas, preferably really A areas where the average household income is about 100K, because that reduces the risk of delinquency, which typically comes in during the recessionary market cycle, which I think we all can agree that currently, even if we are not in a true recession, it's definitely not the bull run that we saw up until 2022. So that's that's basically what our thought process was.
And Jay, you and I were talking, and Anthony were talking over lunch yesterday. We all own our personal portfolios of real estate, and kind of what we've seen in more of the workforce housing in our personal portfolios. And there has been a dramatic shift, in some of those secondary and tertiary markets outside of the 275 loop that is filling the strain. So that's why I feel so strongly about the opportunity in this investment. As Jay said, median household income, great microeconomic indicator that you're going to have a nice tenant base to pick from. And this property has 110,000, I think it was 110,000 median household income, which is really, really strong. Which, obviously that gives us a nice pool of potential tenants. We'll go right into over 2.1 million in CapEx was spent since 2021 by the current owner. Which is nice to see, as Jay mentioned, more of a turnkey sort of operation, but still opportunity for our management to come in, implement, decrease OpEx, our overhead costs. And also, as we get further into this presentation, you'll see there's still some nice opportunity for rent increases. I think the average was about $143 per unit or so. So there's still a lot of opportunity to drive value and increase revenue for this building. So what we're seeking 4.3 million in equity commitments. That is an 80-20 split. So 80% of the equity position would be the Class A or LP investors, while us, the managing partners, will retain 20%. So you want to go to the next slide, Jay?
Yep.
A little bit about the investment summary, and Jay, chime in at any point in time. We are purchasing this property for 10.7 million. As mentioned, 72 units, construction's 1966. We went through the entire building top to bottom yesterday, and it looks really, really great. B-class building in an A-class area. Purchase cap is about 6.95. This is a 6-year hold. And a little bit about the returns, 40% IRR or so projected, really strong average annual return of 16 to 17%. And a metric that I really look at is the cash on cash, almost yielding an 8% cash on cash return, which is very hard to find today to get a deal to pencil to 8%. So equity multiple, almost 2. So that's right in our wheelhouse, Jay. What else would you like to highlight here, Jay?
Yeah, I think just the investor returns and terms. So 6% preferred return. 80-20 split is what we mentioned on the previous slide, but that's up until a 15% hurdle. And then after 15% average annualized returns, it switches to 60-40. So 60 going to LPs and 40 going to GPs. And why is that hurdle and pref? Just in summary, in a syndication model, what 6 pref means is 6% of the cash flow immediately goes to LPs or investors. And anything on top of that 6% is split between LPs and GPs. So the investors are prioritized, but at the same time, the GPs are incentivized to overperform. So the hurdle is there so that if you overperform and achieve significantly over 15% in AAR, that's when the GPs start to get a little bit more. But during the operational phase, typically operators or the general partners don't really make much, but that's really why the structure is in place. So anyone who's new to a syndication model, I'm trying to answer that question for you. But if there are any other questions on this topic, we are more than happy to do a one-on-one Zoom call as well. The acquisition fee is 1%, asset management fee is 2%, and then refi, which is a refinance or exit fee, is 1%. So we have tried our very best to keep these fees to a very minimum, because our goal is not to get rich off of these fees. The goal really is to make sure that the investors are keeping almost all of it upfront. And then if the deal really performs really well and we get a successful exit, that's when we as GPs really make our portion of the profit. So that's really basically it. And also another thing to highlight, I would say, is building class is listed as B, and some people might ask that it's a 1966 construction. How does that make it a B class? But essentially, it's not going off of vintage, but it's going off of the asset condition. So the entire property was renovated outside and inside since 2021 through 2024 with $2.1 million in capex spend, and which is why, as it stands today, it's a B class asset.
Yeah, it's a beautiful building. And I have to highlight too something here too. Acquisition fee of 1%. For those that are more experienced, they would understand that typical acquisition fee is closer to 3. So that's a pretty low fee based off the industry standard. One thing I'm really excited about for the investors is this property cash flows day one. So what we're doing is we are pulling our monthly distribution to start at month 7. So we want to make sure that we benefit the investors, the LPs. We're going to give ourselves 6 months to get our feet underneath of us to make sure management's in place and things are running smoothly. However, we could pay out, day one. It does cash flow. So month 7 will be when distributions start. Those will be monthly, sent via EFT through cash flow portal. And we usually send those out on the 15th of every month. So Jay, next slide. I'm going to show them a little bit about the property. It's a really nice looking place. So you go ahead and highlight
pictures. Yeah, I mean, these are actual pictures of the property as it sits today. And I think one of the comments I'd made earlier with Andy was every time we do these presentations, because we do heavy value add deals, it's almost, these images are almost gross because the assets that we buy need a lot of work and they don't really look investment worthy, right? Because you have to put in a lot of work to make them look nice. But in this case, the property already looks great. The parking lot was recently seal coated. The roofs are brand new. The elevators are brand new. Some amenities were added. So these are actual pictures from the property. The only thing that we plan to do is just pressure wash the building to remove some of this mildew. But other than that, not much is really needed on the exterior of the property. So some more pictures. They added this deck and amenity area essentially just to kind of hang out. And then more pictures. Here we have some interior pictures. Now, of course, these are interior pictures of vacant units. Almost might seem like marketing pictures and virtually staged, but that's why we walked all the units yesterday to get a sense of how do all the units actually look like. Just a couple of units that are typically shown to you is not a true representation in most cases. But thankfully, in this case, it was. I mean, most of the units actually are in great condition. So these are some of the samples of actual units that we walked yesterday. And of course, not all of them were as clean. Some people are a little bit more messy, and we picked the ones that were a little bit more cleaner, but the renovation quality was pretty much identical throughout. The same LVP floors, same stainless steel appliances, same bathroom upgrades. We've got more pictures here of some of the bathrooms and kitchens. So it was pretty consistent in terms of the quality of workmanship and also the materials used, which is fantastic, right? I mean, that's exactly what we like to do, is make sure that all the units are consistent and all the units are upgraded to a good quality, that way we continue to attract good quality of tenant base. So except for 10 units, all the 62 units were pretty much fully renovated to either gold or platinum standard, which is kind of the top end of our list of standards. So essentially, when we talk about bronze, it's like a basic turn, and then gold and platinum, where you can see that there's style showers, there's stainless appliances, nice new cabinets. So stuff like that, which typically costs about $15,000 to $18,000 to renovate. So pretty good amount of work that's already done for us, thankfully.
Yeah, and I got to say, we've turned hundreds of units throughout our portfolio, and you can get a pretty good idea of craftsmanship. And it was really nice to see, every seam in the LVP was tight. Just the small things that you maybe not the normal person would figure out, but if you've seen enough units and done enough, construction turns, you'd start to pick up on the small things. So it was very, very well done, which is nice to see.
Absolutely. And this slide is just a summary of all the CapEx work that was done in the past 4 to 5 years by the previous ownership. I won't go through every single line item, but that's $2.1+ million in CapEx spend. But the big ticket items were interior renovations of about $744,000 across the 62 units that have been renovated. But few other large ticket or big ticket items are like the elevators at 370,000 and the roof at 250K. A lot of these things are deferred maintenance items and they don't really have an impact on the rents. So if you buy a property that does require a lot of deferred maintenance to be addressed, then you are spending a lot of money on CapEx. It takes a lot of time, but it does not immediately boost the rents. What makes a difference on rents is how nice the units look, because that's the only thing that the tenants care for. So it's good that all of these other items have already been addressed. That way we can focus on just renovating 10 more units, maybe adding an amenity, and then maintaining and retaining our tenant base. So the tenant base here is really solid and just ride on that natural rent growth. So we are not even projecting a 20% rent growth here, really just about a 3% rent growth in line with the market. And that's it. It's a simple buy and hold. So it may sound like there's not a lot of work to do, but operations is very work intensive. There is not a lot of CapEx work to do, but that's a good thing because it reduces the construction risk, which all of us together as investors have to take. Because we always know with heavy construction, there's always something that does not go according to the plan. So I think with that, we'll keep moving. Our goal is to stay within about 50 minutes or so and leave some time for Q&A at the end. So what we'll do is some of the slides that have a lot of data on them, I'll try to glance through some of those slides, but then any data nerds on the call, if we want to do a one-on-one Zoom and dive into the data, I'm more than happy to do that. Jason, who helped underwrite this deal, who was one of our team members, is the data guy. Happy to have him on the call as well. But on this call, we are going to mainly focus on the business plan. What's the story with this asset and what do the returns look like? So now coming back to the rent growth, the leases signed in 2025, to give you an idea of the most recent rent growth, have been 4.6% higher than last year's leases. And even the renewals are coming in about 4.6% higher. So we are already seeing about a 4.6% rent growth at this property in its as-is condition. The actual rents are about $143 below the comps. And we will take a quick look at the comps here in just a minute. So these are the rental comps. And again, I don't want to focus on every single number on this slide, but essentially the key thing to note is this is the asset that we are buying. And all of these other line items are assets in the surrounding 2-mile radius. Now, not all of them are a like kind asset comparison because the first two, as you can see, are a lot newer Class A developments. So we cannot, that won't be an apples to apples comparison, but just keeping those two aside even, the other ones, Old Town, which was 1965 construction at $1.97 in rent per square foot. Lakeshore Drive, this is actually more of a C-class asset, 67 construction. The build quality is not as great, and it was renovated over 10 years ago now, so it's already a little bit dated. They are getting about 1.56. Montgomery Plaza, also an older property, 1.84, 1.79 for Twin Pines, 1973 construction. And as you can see, the occupancy level for all of these assets is very good. That just shows a strong demand in this Amberley, Kenwood, Silverton area, because this is a Class A area and it's still close to downtown. Because typically what we see is Class A neighborhoods are typically suburbs, about 20 miles to the east of Cincinnati or up north. But in this case, this is an urban or midtown location, less than 5 miles to downtown, close to hospitals and universities, which is why you see a really strong demand. and which is why you see high occupancy levels. So I think there's a lot of room to catch up in terms of rents. 1.26 is our property, and without our property, if you just look at the average of all the other rent comps, we are at 1.85. So we are not assuming that we'll get to 1.85. We are only projecting a 3% rent growth, but it's good to know that there is room to grow in terms of rents, because you don't want to be the most expensive property in the market, to make sure that you keep healthy occupancy levels.
And I'll just
Anything
mention,
else to add, Andy?
yeah, I just mentioned to the investors that don't know us or haven't invested with us before, we have about 130, 140 units in this respective area already, just within a short distance. And we've seen some really nice, consistent rent growth in the area. Is you see some gentrification coming down Montgomery Road, going from east to west, away from Kenwood Mall. So I'd say, there's some operational efficiencies there that we'll drive with our in-house management and operations team too, since we already have 120, 130 units in the area as well. So
Absolutely. Yeah, that's a good point. Because I think one of the things that we often get asked by our lenders is, do we have payroll accounted for this? But because we have all the units in this close proximity, it helps us with management as well. That way we can actually share the leasing and maintenance staff across the portfolio. So here's the rent roll summary and projection. Again, a numbers slide. So we'll try to keep it high level for this call. But essentially what this column shows you here is for different type of units, what is the current average rents? Another thing to note is our unit mix. So this property primarily has 2-bedroom, 2-bath units, and that typically is the most sought after unit type. And not only is it most sought after, but that type of unit mix tends to retain its tenants long term, because usually families move in 2 beds and 3-bed apartments, and they end up staying longer. In contrast, when you have studio apartments, you usually have students or younger professionals, and in 1 to 2 years, they essentially move out for jobs or because they start a family. So in terms of unit mix, I think the unit mix is really good. We also have some 3 beds, and there's a couple 4 beds as well, including one single family house that's on the property. In terms of the rents in as-is condition, here's the rents in as-is condition in terms of kind of comparables. And then our pro forma or projections are about 7% higher. Keep in mind that 7% higher after we renovate the 10 units. So this is not just factoring in the natural rent growth. It includes the 3% in natural rent growth, plus another 4% after renovations of 10 other units over the course of about 18 to 24 months. So we are not expecting a 7% rent bump by the end of the year. It's more like in 18 to 24 months after the property is fully stabilized. Okay. Now moving on to financials. So we've got some more numbers coming. I think this is one of the most important slides. So Andy, chime in on this slide as well, because this is what usually you as investors would like to know is for $100,000 invested in the deal, what does the year-over-year cash flow from rent collections look like? And then finally, when we sell the property, what does the profit look like for a total return on your investment, right? So this number on the top left in blue is your original 100K invested in the deal, which stays in the property until we sell the property. Now that gets you about 6.75% in cash flow first year, which is 6,752. Now, mind you, this is a projected cash flow, so these numbers can slightly go up and down, but the property actually as is cash flows over 7% going in. In year 2, that cash flow jumps up to 7,736. Why does it jump up? Because we gain efficiency from operations and we slowly start to push the rents. So we start to increase our income and reduce our OPEX. Year 3, it starts to go further for same reasons. And during the first 3 years, the cash flow looks even healthier because we are paying only interest payments. So the loan on the property is not amortizing yet, which means we are not making principal payments, which helps with the cash flow. Now the cash flow drops in year 4 for that same reason. We start to make principal payments. So that means that we are actually now building more and more equity in the deal, but it's still a pretty healthy cash flow at 7.58%. moving up to 8% and then 8.56% at the end of year 6. So it's a pretty healthy cash flow deal, especially for the location and asset class, because after underwriting hundreds of deals, we typically underwrite roughly about 80 to 100 deals a month. What we see is these cash flows are usually seen in Class C neighborhoods where there is a higher risk of evictions, of delinquency. But finding this cash flow in Class A location is extremely rare. Like across all the deals that we have done so far, honestly, we have not seen this type of cash flow. So it's refreshing to actually find a deal that cash flows this well without having too much of a construction risk. And then finally, when we sell the property, you get the 100,000 that was originally invested back, and then an additional almost 49K, which comes from the profit from sale. So in total, you get 48,973 plus 47,591. That's your return on investment. And then on top of that, you get your original capital back for a total value return of 196,563 at the end of 6 years, which is why we say that this is a 1.97 equity multiple deal, meaning if you put 100K at the end of 6 years, your 100K becomes 1.97 times your original capital. So that's basically the summary of investment. Andy, anything else that you would like to highlight?
I just, I'll parallel to what you said is very rarely do we see a cash on cash return like this in an asset in this market. And for it to generate almost $23,400 in the first 3 years of just pure cash flow is one of the reasons I want to put my money in the deal, right? I actively own my own properties, and I can make more cash flow off this deal than I can off some of the properties I own actively. And I'd say too, almost hitting 9% in year 3 is very strong. So these are great looking numbers. Very well explained. Thanks, Jay.
And then let's briefly talk about bonus depreciation, because I got this question from a lot of people I spoke to. So I thought of at least providing a summary. This is a pretty complex topic and you can go into a rabbit hole. So I would definitely say for additional details, we are willing to do a one-on-one call, but you should really talk to your tax attorney or CPA because everybody's personal situation is different. But at a high level, 100% bonus depreciation is back and it's here to stay. So it's not going to taper down like it did last time when Trump had passed the 100% bonus depreciation bill. But what does that mean? Because I think there's a lot of confusion with some people who think that for 100K invested, they actually get 100K in depreciation year 1. But that's not how it works, because all of your 100K it's not something that you can depreciate, because in commercial real estate, about 20% of the value goes towards land, which cannot be depreciated. And the other 80% can be depreciated over a different timeline. So some things can be depreciated over 27.5-year timeline, some over 15, some over 7, and some over 5-year timeline. So essentially, like your structure, your foundation, all of that depreciates over a 27.5-year timeline, while your fixtures, ceiling fans, appliances, carpets, LBP floors, all of that stuff depreciates over 5, 7, and 15 years. So which is why in terms of bonus depreciation, the items that can depreciate over 5, 7, and 15 years can be bonus depreciated in year 1. So it's still a very good chunk, as opposed to, for example, if you did straight line depreciation over 27.5 years, this asset of about 11 million only gets you about $400,000 in depreciation for the entire asset. But when you do bonus depreciation for about 100K invested, you would get about 48,000 in depreciation right in year 1. And even if you don't need all of the depreciation in year 1 to offset your other income, it actually can be carried forward. So if you only use 24 of it, you can use the other 24 next year on your taxes to depreciate any of your other passive income that you're getting, right? And if you're a real estate professional, you can actually depreciate your active income as well. So at a high level, that's essentially the key to understand. But one thing to also note is when you sell the asset, hopefully for a profit, right? You're not really getting depreciation. You're actually getting appreciation because you sold the property for more than what you bought it for. So all of that bonus depreciation that you took in the last 6 years is going to get recaptured. So there is no legal way to avoid taxes. All of these tax strategies are to defer the taxes. That way you can continue to reduce your tax liability year over year and grow your pre-tax wealth. That way your pre-tax wealth is compounding. And then the year when we sell this deal, hopefully you buy another deal that will give you enough bonus depreciation to offset the capital gains from this deal. And that's how you basically keep playing the game and defer your taxes. So I think with that, we'll move on to the next slide, which
My
is
favorite
about,
slide,
yeah,
Jay.
go ahead, Andy.
This is Jason's brainchild here. So, you know, one of my favorite slides because it gives you really hypothetical scenarios of what's the likelihood of our expected returns from this deal based on our pro forma and underwriting. And it's a nice barometer, right? We always try to be as conservative as possible, but not too conservative. So we want to estimate that, you know, there's a 60% likelihood of our pro forma and our expected returns happening of right around 2x, as we mentioned to you before, almost an 8% cash on cash return. But it's nice to see, well, what if we did really, really well? What if we really drove our OPEX down to, what if we dropped it down to high 30s? And we have some properties within our portfolio that are almost at 35. So it is achievable. But it's nice to see the hypothetical scenario of what if we did pull down our overhead expenses and increased our income? What would that look like? And what would that do for you as an investor with your returns? And this achievable shows, well, okay, well, maybe not a 2x, maybe a 2.2x. You know, maybe not an 8% cash on cash. Maybe we get to 9. And then we look at what does a very ambitious return scenario look like, and pulling down our OPEX to 38, which is really not out of reach, to tell you the truth. But you know, it would be you know, not in the best interest of our investors to assume the best in a deal. That's not really a fiduciary duty that we take on here with your capital. So we want to say the highest chances of likelihood are what we're projecting. Now the contrary is also, you know, a factor. What if we underperform? And that's the very conservative, you know, here, first column here, that, yeah, maybe it's 1.5 return, you know, 1.5x, not even a 2. Maybe the cash on cash stays at 6, at flat. And I think one of the slides that follow this is a stress test on, you know, potentially maybe a recession where we don't have any rent growth whatsoever, in a hypothetical scenario of what I think it was 3 to 4 years, right, Jay, that we modeled it
Yes,
out
3
for.
years.
So you'll see that coming up next. But I really like this visual here because even if you're an advanced investor and you've invested in 10 or 12 syndications, or if you're just a new guy that this is your first one trying to learn, this is a great model just to see, okay, if they do what they say they're going to do, this is what I would get. But what if they do better? What if they do worse? Jay, anything to add?
No, I think you covered everything. Because I think the only thing is our ambitious scenario is basically how most deals are actually underwritten. Like most deals are underwritten for 4% rent growth. Even I've seen many deals underwritten only for 5% vacancy. So I think understanding this as you start to get, you know, more and more savvy in investing is going to make a really big difference, because by the end of the day, the IRR and cash on cash numbers, they can be drastically changed by making a few tweaks to your assumptions in terms of rent growth and vacancy and stuff like that. So, which is why we like to show some of these details so everyone gets an idea of how we underwrite the deals and what are the assumptions that we are making. So, okay, moving on. Oh, speaking of assumptions, so this is a slide on our underwriting assumptions. Again, this is not a slide that's telling you a story of how beautiful the property is, but if you are really fascinated by numbers and understand that what are the assumptions that we are making to arrive at the pro forma returns, this is the slide. So any tweaks that can be made to these numbers can drastically sway the pro forma returns, which is why we like to show all of these numbers to you all. So over the course of 6 years, we are assuming a flat 3% rent growth, which is very much in line with market. So Cincinnati market is seeing 2.9 to 3% rent growth across the market, across all neighborhoods. and some of the Class A neighborhoods are still seeing 4 to 5% rent growth. Other income growth, which is RUBS, pet rents, late fees, all of that stuff, anything outside of rent, we are projecting about a 2% income growth, right? Now, in terms of expenses, we are assuming a 3% inflation on insurance. We are thankfully, knock on wood, relatively blessed in the Midwest that our insurance prices have not gone up like crazy. The insurance prices are still pretty much in control, and we are not seeing crazy inflation on insurance. Our property tax assumptions are 10% increase in year one and 3% increase year over year after that. So we will be doing something called as an entity purchase. So we are basically buying the seller's entity. So that basically essentially prevents a reassessment of taxes. Although we are doing that, we are still actually accounting for 10 plus 3 more % of tax increases through years 1 through 6. All other expenses, inflation at about 3%, which is kind of in line with 2.7% inflation index that we are seeing today. In terms of our physical occupancy and other losses like bad debt, which makes up for total economic vacancy, we are projecting about 11.6% first 2 years, 10.6% year 3, and then tapering down to 9%. But currently, the property sits at below 5% economic vacancy. So going in, we are already assuming that the vacancy level is going to be more than double of what the property is currently seeing. And then finally, the OPEX, which is operating expense ratio, starting out at 42% and then tapering down to 39% at the end of year from years 4 through 6, once we have achieved that stable operations, or more like essentially hitting the pro forma. So again, as Andy alluded to, the properties that we have in our portfolio, a lot of them after stabilization are already performing below this. And this property actually is currently performing with the current seller well below 39%. So they are in the mid 30s in terms of the OPEX. So that's kind of where the numbers are and how we have laid it out. And we'll be sharing these slides with you all as well. So if you have any questions on any of these slides, more than happy to touch base later as well. And this is the recession analysis slide that Andy was talking about. So what we did was we looked at maybe about a 3-year projection. So assuming that if we do enter a recession starting year 2026 through 2028 for about 3 years, where we have absolutely zero rent growth, if we have expenses go up by 5%, so inflation going up to 5%, and then vacancy increasing to 20%, so 1/5 of the property either physically vacant or at least economically vacant, where we have a lot of delinquency issues and people not paying their rents, we are still maintaining a pretty healthy DSCR. And what DSCR means is it's a debt service coverage ratio. What that means is that the revenue the property generates, how much, what portion of the debt can it cover? So it can actually cover 1.47 times the debt. So we have more than enough, even in this recessionary scenario, to actually pay down the debt and still be able to cash flow for investors at about 4 to 4.4%. So anything else, Andy, you would like to highlight on this slide?
I just remember underwriting deals trying to get to 1.2, and that was hard just for the lenders. So it's nice to see one at healthy at almost 1.5. That's a tough metric to hit. And I know there's people on this call that would probably agree. Those that are more experienced. So a nice looking.
All right, we'll keep moving. So essentially, this is a slide on our debt terms. We are going with agency debt because it's a stabilized property at 5.6% interest rate. We actually have underwritten for a rate buy down about 80 grand, but thankfully the rates have actually dropped, and the rates now without a rate buy down are at about 5.6%, meaning that 80K that we have set aside for a rate buy down can be now used towards reserves. The term on this would be about 7 years. 36 months or 3 years out of this 7 years is going to be an interest-only payment period. The loan will be amortized over 30 years. The prepayment penalty is defeasance or yield maintenance. What that means is if you pay down the loan sooner than 7 years, then you basically have to give the lender the yield on their capital. So the difference for about 3 years, let's say if we repay the loan or sell the property at the end of 4 years, anything that they would yield on that capital that they have lended to us, if they reinvest that in the bond market, what is the difference between the returns they'll get from the bond market versus the interest we are paying? So that difference is the prepayment penalty at a high level. Loan balance is considered at 70% loan to value. So 30% would be the down payment, which will come from all the capital that we are raising collectively. And then the 7.5 million roughly is going to be the bank loan or agency loan. Now, this property, because the going in DSCR is extremely healthy, is most likely going to qualify for 75% LTV, but we just underwrote for a slightly lower number just to be conservative. So if our leverage is higher, then the returns will actually slightly look better. And then, like we said, going in DSCR of 1.77, so really healthy DSCR. Moving on, here's the CapEx summary. So what's our CapEx plan? So we don't have a lot in CapEx, but we still have a healthy CapEx budget, given that it's an older property and it's always a good idea to sit on healthy reserves. So in terms of interior CapEx, we are going to do partial upgrades, and that's essentially unit turns as people leave. We have set aside 120K for 40 units. That's $3,000 per door. And typically this expense is almost always considered repairs and maintenance. You will not see this line items in CapEx, but in addition to R&M, we also have a CapEx bucket for this line item. Full unit upgrades, now that's a true renovation, full renovation, which is a true capital expense. We have about 180K set aside for that, or there's a typo here, 10 units, because other 62 have been renovated. We have an HVAC reserve to replace about 15 HVAC systems at $7,000 a piece. The HVACs are kind of 50-50, about half of them are newer, but about half of them are older. So a lot of this will be factored into R&M as well. But in addition to repairs and maintenance, we did want to have a healthy replacement reserve for HVACs. And then finally, deferred maintenance reserve. There is no need for any deferred maintenance reserve because all the deferred maintenance has been addressed, but we still have another 10,000 in deferred maintenance reserves. Now, in terms of exterior CapEx, we'll just do an exterior pressure wash. There is a reserve for parking garage repair. This was previously not a reserve. There was a minor repair needed in the parking lot, but it was since then repaired already. So it's already been fixed. We noticed that during our most recent walkthrough yesterday, but we still kept that line item as an additional reserve. Amenities, we are most likely thinking about doing a dog park in an area where they had a swimming pool that has been filled in. We'll plan on doing that maybe after 1 to 2 years after looking at how well the property cash flows. So not thinking about spending this money initially. And then other miscellaneous deferred maintenance reserve, another 20 grand. So that's the exterior CapEx. Interior CapEx, on top of that, 10% of that amount is an additional reserve. And then we have 3 months of operating reserve. So 3 months of principal, interest, taxes, and insurance. So you will see that in general, most of this 546K is reserves. This line item, 1, 2, 3, 4, almost all of it is reserves. The only line item that we definitely would spend money on is the 40 full or 10 full unit renovations at about 180K. So with that, we'll keep moving and talk a little bit about Cincinnati as a market and give you an overview of the location. So Cincinnati as a market, now, of course, a lot of eyes are on the Midwest because Midwest is topping most of the rent growth charts. But Midwest has always been a steady Eddie market. So right now we are seeing 4 or 5% rent growth in nicer areas. Even during COVID and the boost that we had in rent growth, we were seeing about 8 to 10%. So typically in this market, we do see positive rent growth, irrespective of the market cycle because of the supply and demand equation. Additionally, Cincinnati as a market is home to about 8 Fortune 500 companies, and the employers are diversified across several industries. So we have a good presence in financial sector with American Financial Group, Cincinnati Financial Corporation, Paycor, Western Southern, so insurance and banks. Fifth Third and PNC banks have huge operations here as well, and so does the US Bank. A huge hub for healthcare as well. Omnicare, UC Health, Children's Hospital, MedPace Clinical Trials, TriHealth. And then we have retail, GE Aviation, all the Boeing engines are manufactured here by GE, AK Steel, Cintas, sports teams, P&G in consumer products as well. And some of these industries are extremely recession resistant. So it's always good to have this exposure to several different industries, because that way you know that your tenants are not overly reliant on certain one industry sector. This is the slide about rent growth in the market. And you can see on the left, these are the top rent growth markets as of last month, July 2025. The information comes from CoStar. And you can see a lot of Midwestern markets. So Cincinnati is number 4 on the list, but we also see Pittsburgh, Kansas City, Detroit, Minneapolis. Just to kind of show that right now, of course, Midwest is doing really well. But in general, these are the numbers we have seen in the Midwest year over year for decades. So we don't see that significantly changing. And then lastly, some more numbers. So the only thing that I would like to highlight your attention to is average vacancy. So average vacancy in 2023 in Cincinnati market as a whole was 6.6%. And it stays around the same in terms of projections all the way from 2023 to 2027. And we underwrote for about 11.9% for the first 2 years, tapering down to 9%. So we tried to be more conservative than the CoStar projections. And similarly, rent growth projections, you can see that it's about 1.5, 4.6 in 2024, 4.2 in 2025, 3.7 and 2.9. And we underwrote for about 3%, which is still lower than average of all of these pro forma or projected numbers. So we'll keep moving here, just in a sense of staying on time, hopefully. And then this is the location overview. This is where the property sits. So this right here is the property location. It is, like we said, it's in Class A location with a median household income of over $100,000. And in 3-mile radius is over 110,000, about 118K. So all of these areas to the right and immediately to the left here are all Class A neighborhoods. As we go further left, it starts to become Class B and B minus, but all the surrounding areas. And Amberley, by the way, is predominantly single family home neighborhood. So there's about 360 multifamily units. And when you buy 72 out of those units, you get a big chunk of that total inventory that's available in that neighborhood. And the county is not issuing any more permits to build new multifamily in Amberley as a neighborhood. So, and then it's also very close to Kenwood Mall. It's a very high-end mall with high-end stores, Gucci, Louis Vuitton, Anthropologie, and all of these stores. And it's one of the malls that's really thriving in Cincinnati. Andy, anything else in terms of location that you'd like to highlight?
No, I think to keep on time, we should probably move on through.
Perfect. And then lastly, our team. I guess introduce myself, brief background about myself. I have roots in technology. I have a degree in computer science and information systems. And then I worked in consulting segment doing cybersecurity work for about 10 years. And late 2019 is when I got into real estate investing more as an investment vehicle, and then just fell in love with the process and what real estate can do to create freedom. And now have been full-time real estate investor since 2023 and have invested in 20 plus deals now. So Andy, over to you.
Yeah, real quick, currently vice president of sales at a pharmaceutical distribution company. Been there for most of my career. I know we got Tom on here, or was on here, a fellow pharmacist. So we got some in the industry, Terry. But got in real estate about 6 years ago. My wife and I started to create our own portfolio, buying properties in the area, and just really love the flexibility and freedom it gives you to really bring in an additional stream for wealth creation. One thing to note, I think, for anybody on the call that doesn't know us, when aligning with the sponsor, one thing to know about Prosper is all three of us, DJ, who's our managing principal, me, and Jay, all three of us have owned and operated our own portfolios before we raised $1 of investor capital. which I think is very important to know because we understand what it takes to run a successful business in order to drive revenue for commercial multifamily. So I think that's a pretty big benefit in aligning with us as a sponsor.
Andy, I think you can cover this slide as well at a high
Yeah,
level.
yeah. Let me finish up with this since we're almost out
Yep.
of time. Just real quick, and this will be in the appendix, so you guys can see this if you like. Quick blurb on our portfolio. What's our experience like? 7 years of combined property management experience. Over 500 units in our portfolio. I think we're at 550 or so, right? This will bring us to about 620. And then, this would bring us out north of 65 million in assets under management. Taking 5 properties full cycle, which were J's, some of those were J's as well. And then one thing to note on the average returns, about 19% average IRR and about 2.8 on the average equity multiple for the deals that we've disposed or exited from. So next page, Jay. And this is really important. I wanted to get to this before we ran out of too much time. Since we already have funding commitments coming in as of yesterday, the timeline in this deal is very important. We do have Cash Flow Portal, which is our investor interface and CRM, in which how you would invest in this deal or sign of commitment. We're taking open investments only right now, no soft commitments, and we've already actually have funds coming in on the deal. So that started yesterday, or actually it was on the 18th it started, but yesterday we started to have some funds coming in. So it would be very important to know that if you do have interest in the deal and you do want to commit, that all can be done through the process through Cash Flow Portal. Accredited investors only. So you can either have a letter provided by your CPA, providing that you are an accredited investor. That is only good for 90 days. So if you have one already and it's older than 90 days, we will need a new one. You can also use a third party through Cash Flow Portal called Parallel Markets. It gives you the ability through this deal, when you do sign in and go through the process of committing, it will allow you to use them as a way for you to get certified as an accredited investor. I think it only takes about 24 to 48 hours as well for them to get back to you. So a little bit about next steps would be, if you have interest, if you have questions, reach out to Jay and I. We'll do our best to answer them for you. I know we had some coming through the chat. And we look, obviously, to finish our due diligence here pretty soon. And then we already have started working with our lenders, as Jay probably spoke about earlier on this call, from what our expected debt terms are. And then we project to close sometime in late October. So Jay, anything else to add?
No, I think you covered it. We'll
Cool.
keep moving.
I want to
Final
highlight
slide.
one more thing, Jay, just so everybody knows. If you can go back to that slide.
Yep.
This is a first to fund opportunity. So we'll be securing spots for those that are first to fund, which means wires in first. That will commit your spot. And that's where the priority will be given to those who have already sent in their wire transfers. Since we had so much interest in this, we do anticipate this to oversubscribe fairly quickly. So if you have any questions through the process, feel free to reach out to myself or reach out to Jay.
All right. I think, Andy, primarily that's all we had. This is our contact details. We've already mentioned about 100K open only to accredited investors. These are just some of the FAQs, most commonly asked questions that we get. And then to submit your commitment, you will get this link via email, and we'll also share this deck, or you can scan this QR code. So this link will take you to our investment portal, which is cash flow portal. And it's a pretty step-by-step process. The PPM and all the addendums are in one document. So hopefully we've tried to make it as easy as possible for you all to kind of follow along the documents. And once the PPM is signed, you can wire the funds. And that's about it. And then before closing, we countersign all the documents.
Yes.
And that's basically it.
That's correct. Exciting stuff. Any questions? I think we can see a couple in the Q&A. So Anthony, you want to start that out and bring those to JRI?
Yeah, sounds good. Great presentation, guys. Jay, you had mentioned the entity purchase, and there's a question around resetting depreciation schedule because the entity has not changed. I think they just want a little clarity around that.
So we have done another entity purchase before, and we were able to use bonus depreciation because by IRS standards, it is still considered a sale. So the entity was sold and all the assets owned by the entity were sold, and every time there is a sale, technically you can restart your bonus depreciation or depreciation timer. But that's a good question. We will definitely double check that with our CPA as well, because the other route we can take is a drop and swap, where we don't buy an existing LLC, but the property gets dropped into a new LLC, and then we buy the new LLC. And either route you take, essentially, the sale does not get registered in the county records. So it doesn't trigger a tax reassessment. I think that was Tom's question. Hope that answers your question, Tom. And you guys have ability to unmute yourself and ask questions now as well. And then I do see a question for myself. I'm not sure if someone's logged
Jay,
in
how are you
as
asking
me.
yourself questions?
It says Jay Balkar. Well, I don't know who asked that question, but we'll answer it anyway. Given the positive cash flow, why is the current owner selling? I don't know if this is my wife logged in from my other computer, giving me a hard time here. But
Oh, I hope so. I hope so.
But essentially, the current ownership group is also a syndication company. So in syndications, you own an asset for about 4 to 6 years. And once you're at the end of your business plan, and once you have achieved what you set out to do, you sell the asset, because as operators, you get paid at exit. So essentially, once the business plan is realized, the operators sell the asset and then also give the promised returns or projected returns back to their investors. That way the investors can recycle that capital. So essentially, that's the main reason why they're selling. And quite honestly, they were thinking about refinancing too. We know that for a fact because we are working with the same mortgage broker. So they were basically trying to see if we can sell this asset for a relatively decent price. They're going to sell it. Otherwise, they were just planning to hold on to it by refinancing the deal. So
Both great questions, even if it was you asking yourself, Jay. So good work. Well, investors, I think we've taken enough of their time. Look at this, ending right at 9 p.m. on the dot. So, Jay, Anthony, thank you for being here. I think this was a great webinar. And for all those that have joined us, we appreciate it. Any additional questions, please feel free to reach out to us via email. Also, our mobile numbers are put on this offering memorandum, and we hope that you join us. So thank you all and have a great evening.
Great. Thank you all.
Take care.
Thanks.